Hi, everybody. Welcome to tonight's live stream. So it's a really great show we have lined up. My name is Ian, and tonight we're going to be talking about getting a mortgage in Canada and learning about how your credit score affects your mortgage or your ability to get a mortgage. So I'm really excited about tonight. We've got a guest speaker, Donick Abad, and I'm going to tell you a little bit about Donick. So Donick is a mortgage broker and he's a licensed branch manager as well. He's investment and life insurance licensed. He is a faculty of the NSCC Ivany campus in the retirement planning department. He is a real estate investor. He's worked as a hedge fund accountant. He's worked for some big companies, so Ernst & Young, PricewaterhouseCoopers, and KPMG. He's a family man, so he's got a wife and 3 young children. He's a big-time community leader in the Filipino community here in Halifax, and he is a top 25 immigrant awardee by My Halifax Experience in 2017. So that's a pretty extensive resume, and we're really happy to have Donick here, and I'm going to introduce him right now to the screen. Here he is. Hi, Donick. How's it going?
Doing great, Ian. How are you?
Really good. Thanks for being here tonight and offering to share your experience and wisdom with all our viewers.
Thank you for the opportunity. I'm really excited to be able to share and make an impact, especially in the immigrant community. This initiative that you have is amazing. I'm pretty sure it will help a lot of people. I wish I had this opportunity when we arrived back in 2010 to learn the ropes easier, right?
Mm-hmm. Yeah, can you just tell us a little bit about your experience immigrating to Canada? So you came in 2010, you're from the Philippines originally. Can you tell us a little bit about that experience?
Yeah, we actually moved from from the UK. So we were in the UK. I was with PricewaterhouseCoopers in there. But prior to that, my wife and I loved traveling. So we were in the Cayman Islands prior to that, and then San Francisco, and originally from the Philippines. And a lot of people would usually ask me, why did you pick Canada over the other countries that you've been? Canada is amazing, especially in Nova Scotia. People are very polite, and we love helping people here in Atlantic Canada. So it's an amazing opportunity. We came in here as a skilled worker. Back then, there was huge need for accountants. So I'm an accountant by trade. There was a huge need for accountants in Nova Scotia. So in Canada in particular. So it was a great opportunity for us to be able to move here and still be able to find a job that was in the industry that we were thriving before we moved to Canada.
Great. Yeah. So overall, you're pretty happy that you came all those years ago?
Yeah, absolutely. There are challenges. Any location, any change, any move that you would have, there are going to be challenges. But the cool thing about in Nova Scotia, and particularly in Atlantic Canada, there are communities that are available in here. Not just the Filipino community, other communities too. Nigerian community, Indian community, Mexican community. There are a lot of diverse communities in Atlantic Canada.
Yeah, I know it's changed a whole lot in my lifetime. So I remember back as a kid, there was no diversity. Everybody kind of looked the same. And then I went away for a while and came back, and slowly but surely I noticed more and more diversity in our province, and it's a great thing to see.
Mm-hmm. Yeah. Things are exciting.
Okay. Exciting. Okay, great. So let's launch right into the presentation. So tonight's topic, as we said, getting a mortgage and credit, and Donick is going to take it away. So let's show Donick's stream. There we go. Okay, Donick, right. You're on.
All right. So good evening, everyone. Thank you very much for being here in this live stream. It's an opportunity for us to be able to make an impact in our community. So tonight, I would like to share with you some of the important points that we need to consider when we are buying a house. And one of the key points in there is our credit score. So it's important for us to be able to improve our credit score when we arrive in Canada. That's one of the things that we need to keep our eyes on and focus on. So here are some information that we need to know. Okay, so this is just the company that I partner with for mortgages. So how credit score works. So a good credit score can determine a lot of things today. So whether you will be approved for a credit, that means credit card, car loan, a mortgage, what interest rate you will get on your loans, the cost of your homeowner's insurance, and whether you're approved to rent a house or an apartment. There are apartments and landlords that would require your credit report to determine if the person is indeed going to be able to pay those rents. So it's important for us to be able to establish those. And also on the interest rate, if our credit score is not great, we might have to pay a higher interest. And you'll be surprised, there are interest rates that are around 40. The highest one that I've heard from one of my clients was 41%. So that's a lot of money, right? If you compound that, that might even be higher than the amount of money that you would have borrowed in due time. And then something that we also need to consider, so establishing a credit is a double-edged sword. With its benefit comes some major disadvantages, including the following. So easily available credit can make spending a second nature, right? You're not realizing that you might be spending more than what you're earning, right? So if you can't pay off your credit balances on time, you affect your credit rating. So it means that it would show in your credit report that you failed to make your obligation to pay at least the minimum amount. So it's important for us to make sure that we're making our payment on time, on or before the deadline, at the very least, the minimum amount. And then sometimes you could fall into the trap of paying off some of the credit debt instead of paying the whole amount. What happens there is that you're prolonging the payment of your liabilities. And then when you add credit expenses to the stated price of what you borrow, you end up paying more than what you expected. So we really have to be careful. So what are the things that we need to know about credit score, right? So one of the common method of calculating the credit score is the FICO. So it's the method from Fair Isaac Corporation, Equifax, and TransUnion, which are the two of the major credit bureaus in North America, uses the FICO. But there are some modifications in there. So you would not specifically see your score in Equifax. Seldom you would see that your score in Equifax, it would also be in the same number in TransUnion. So sometimes it will be different depending on the criteria and the reporting that are being done on those two credit bureaus. And then these are the credit score levels as per FICO. So poor credit is considered anyone with a FICO score of 579. Under 579. Average or fair credit rating will be between 580 and 639. And then good credit is between 640 and 719. So with mortgage calculation, typically lenders, we would want to have credit score of around 680 and above. There are lenders who would still give that 620, would accept 620 in credit score. Very good credit will be 720 and to 720, 799. And then excellent credit will be anything above 800. It means that when people see your credit score, they would not hesitate to extend loans to you. But you just have to be careful, though, when you're receiving offers for loans. So what are the factors that affect our credit score. So on average, 65 of your score is coming from payment history and amounts owed. Okay, so making consistent on-time payment and reducing your balances can make a big impact on your score. So around 35% comes from payment history. What does that mean? So are you making payment on time and at the minimum amount? Does it show if you had missed some payments before? Did you had delinquencies? So showing a good report that you have been paying on time and consistently with the consideration also with the amounts owed, which is 30%. What does that mean? So if, for example, you have a 1,000 credit, right? The limit that you could use on your credit card, for example, is 1,000. If your balance in there is 900, it means that you're overusing your credit. So around 70 to 75% would be an ideal level. Lower than 75% would be better. So you just need to make sure that you're not overusing your credit cards. And also for new immigrants or people who just became adult, 19 years old, sometimes you could go to your bank and be able to get a prepaid credit card wherein a prepaid Visa card, wherein you would have like $500 in credit limit in there, or you could load it with $500 and you would use that, and it will be established as a credit under your name. You just need to make sure that it gets registered under your name so that you would start that payment history, right? And then 15% is length of credit history. So that would have an impact in terms of how long have you held that credit card, for example. Pretty common question that people would have is that I have 3 credit cards. This is just an example. I have 3 credit cards. I'm not using it, but that's credit card A, B, and C. Credit card A is the one that you have had for a long time, say, for example, 10 years, but you're no longer using it because credit card B and C have higher points. But in credit card B and C, you might have missed some payments in there. So even though you're not using credit card A, and then it shows that you were paying on time in there, it's important for you to keep that credit card because it would show that, yep, you've been making good payments and on-time payments on that credit card. So be careful when trying to close some of the credit cards that you have. Determine which one you should be closing, not just because of the points that you would get from using the credit card. And then new credit, so inquiries, it would have a positive impact if the inquiry is on different and various debts. So say, for example, you have inquiries for line of credit, inquiries for, you have inquiries for and credit card, line of credit, car loan, and mortgage. But if all your inquiries are on this car loan and there were 3, 4, 5 companies that did an inquiry in your credit score, that would have a negative impact. So make sure before you apply for a car loan, I just spoke to someone last time about their credit score going down because of multiple queries from car dealership when the person was looking for a car. So be careful. Make sure you do your research first before you go to a car dealership. You don't want to have a lot of hard inquiries. When you see your credit score from your bank, for example, those are called soft check. So they are not going to affect your credit score, which is a good thing because you're not asking for new debt in there. You're just checking if your credit score is still good. If you think that your credit score is still too low, you can challenge Equifax or TransUnion. Sometimes Equifax would have a 30-day trial on their for you to be able to have access to their credit report. So you might want to take advantage of that. And then the types of credit used, the one that I was mentioning earlier, having car loan, credit card, line of credit, student loan, and mortgage would help, because it's a lot of people are basically trusting you, right? And then these are the 5 most common credit mistakes that people make. So 1, not valuing your credit. So not monitoring, not checking if it's good. And then raising credit limits. So sometimes by raising your credit limit, it's tempting you to buy more things that you might not necessarily need. And then not monitoring your credit history. Maybe someone already did an inquiry on your credit score, and it was not you. So maybe there was an unauthorized credit inquiry in there, and maybe your identity was stolen. So you have to make sure that you check your credit score and credit report on a regular basis. Number 4, not monitoring your credit score. Maybe it might indicate that you might have missed a payment in there, or there might be a debt that was under collection if your credit score had not gone up or had gone down. And then number 5, knowing the interest rates and the fees associated with your debt. So it doesn't necessarily mean that someone extended a credit to you that you should just easily accept it. Know the impact of interest rate, because sometimes if you're not managing your debt properly, the amount of interest that you're paying might even be higher than the amount that you borrowed. So how do you improve your credit score? So number 1, review your credit report and correct any errors that you find. So you could challenge that from Equifax or TransUnion. And then keep old credit accounts, even if you're not using them. So if it's possible for you to ask for the annual fee to be waived, you can do that. Number 3, reduce your balances on your credit cards to 75% or less of your available credit. So it's a good indication that you're not too reliant on the debts. And then pay your bills on time. Number 5, don't let anyone make inquiry on your credit report unless you absolutely have to associate yourself with that debt. And then number 6, so if you are planning on applying for a big loan, such as a mortgage, don't open a new credit card just to increase your available credit in the hopes of raising your score, okay? And then if, for example, you're planning on buying a house, you already arrived here and you said, oh, it might be better for me to buy a house than rent. Before you buy an expensive vehicle, make sure you move to a house first before you buy an expensive vehicle. The great thing about Canada is that you could buy amazing used vehicles at reasonable prices. So one thing that people would want when they move to Canada would be to buy a house. So here are the things that we need to consider. I won't be going into too much detail in terms of the process of the home buying, because we're going to have Ian's going to have a guest next week that's a realtor that will explain in detail the step-by-step process for buying a house. So in here, I'm just going to focus on getting a mortgage, okay? So here are some of the things that you need to decide. So decide what kind of home you want. So this is going to be discussed by a realtor next week. And then how much you can afford. So in here, this is something that I will be involved in as a mortgage broker. So calculate how much money you have saved for your down payment. Calculate how much your closing costs will be, which would be typically around 2 to 2.5%. And calculate how large a mortgage payment you can afford each month. So based on your budget, it doesn't necessarily mean that if, for example, based on your income, you could afford 500,000 mortgage on a house, that you want to take that, because you also have to consider what other expenses that you would have in your household. Okay, and then calculate other monthly costs that you will be responsible for as a homeowner, and then get help and advice that you need. So we have people who are realtors, lawyers, and everyone that you would need in the crew. And then in here, this is just the home buying process. So get pre-approved. That's one of the important things, especially now. It's a seller's market. You have to be ready before you actually make a pay before you actually look for houses, because it's pretty quick. Houses go really quick. Get the mortgage approval, and then here make the down payment, get title insurance reimbursement for prepaid and large. And then here are the different types of homes. Freehold, meaning you own the building. Condo, you own the unit but not the common area. Leasehold, you own the house itself but not the land that it sits into. And then in here, you might be asking whether you want to have a new home, a previously owned, or a built, or build your own. You have to determine which one you value. New home would have an impact in terms of you have a choice what you want to be in there. Previously owned, it's already established, it's not going to settle. And build your own, it might take longer, but you have a choice of the design that you would have. And then here are some basic mortgage terminology that we have. So high ratio mortgage, it means that down payment is less than 20%. The minimum is around 5%. It requires mortgage default insurance. The higher payments due to insurance premiums. Mortgage default insurance means that if the person defaults or files bankruptcy, CMHC, SAGN, or Canada Guarantee will be the one paying those the lenders, versus the conventional mortgage wherein the down payment is equal or greater than 20%. So the mortgage default insurance is optional. There's no insurance premium, meaning the monthly payment will be lower. And then there's also the closed mortgage. So if you're planning on living in your new house long term, closed mortgage might be better. Interest rates are usually lower, so you save money on the long run. Prepayment penalties if you repay your mortgages before the end of the term. So that's something that you need to be aware. Open mortgage, if you plan on moving in the near future or upgrading to a bigger home, interest rates tend to be higher with open mortgage because you could easily move out of that mortgage. There's no prepayment penalties if you want to repay your mortgage because it's open mortgage. And then this one's a pretty common question. So whether we should take the fixed rate mortgage or the variable rate. So with fixed rate, so it's locked in at the current rate for the term. Typically, it's going to be 5 years, and then you would know how much you'll be paying. So it gives you peace of mind, right? So less money saved on the interest. With variable rate mortgage, interest rates tend to be lower, and then payments may increase if the interest rates increase. And then potential savings on interest in the long run because typically it's lower than the fixed rates. And you have the option to switch to a fixed rate. And then pre-approval will let you shop with confidence. It will also help your realtors to know how much you are qualified to be able to buy a house, and then it will allow you to be able to close the transaction quicker. And then the typical housing costs will involve mortgage payment, maintenance, utilities, property tax, and then day-to-day costs will be groceries, maintenance, and those things. Here are 4 factors to determine factors that we need to do to qualify for a mortgage. One is the credit score. At least 680 credit score will be ideal. And then income verification. So salary, meaning every year you already know what income you'll have. Guaranteed hours. A lot of people who are in healthcare would fall under this category. They know that they're going to work for 35 hours a week or 70, 80 hours bi-weekly. With these two categories, they don't need to have 2 years history. As long as they're past their probation period, they can already qualify for a mortgage, assuming all the other factors would be considered. But if the person has non-guaranteed hours, they have to have at least 2 years history from where they work. And then self-employed and business owner, that's also an area wherein you would have to have 2 years history in your business, because sometimes it goes up, sometimes it goes down. So it's being averaged out. And then down payment is something that we need to be aware of. We need to have at least 5% of the purchase price as a down payment. The great thing about Nova Scotia, we have some programs that would allow people to be able to buy a house through the Nova Scotia Down Payment Assistance Program. And then number 4, liabilities. The lower the liability balances, the higher the purchase price you might be able to purchase. That's why it's important for us to take care of our liabilities, take care of our debts. And then some of the factors, programs that are available from the federal government will be the first-time homebuyer incentive, wherein you put in 5%, the government would be able to match the other 5% if it's an existing home, or 10% if it's a new home. Let me just go back in there. And then the home buyer amount of $5,000 for non-refundable tax credit. And then the home buyer plan with your RSP, you could borrow up to $35,000. And then you might also qualify for the GST, HST. And there are also some strategies that are available. So one will be the Nova Scotia Down Payment Assistance Program. The cool thing about the provincial down payment assistance program, New Brunswick also have something similar. And then you could also use RSP leverage, non-repayable gifts from relatives. There are lenders that would allow that, equity from your real estate property, and also cashback mortgage. So if you're curious in terms of your credit score, you could download our free app. It's MoPolo. This is an app being used by Mortgage Alliance. So in there, you'd be able to see your credit scores updated monthly, and you could also use it for an estimate on your property valuation, mortgage calculator. You could also see our current rates in there. So you can download it for free, and then you could also look up in terms of the broker. You could look up my name in there, Donick Abad, for the mortgage broker. Ian, I think that's it for me.
Awesome. That was very thorough and very well done, Donick. Thank you very much for sharing that. Okay, so this is sort of the question and answer period. So this is your chance to ask Donick a question about getting a mortgage. He's going to stick around for another 15 minutes or so and answer all your questions. So fire those off and get some expert advice. Okay, so yeah, we'll just wait around and see if anybody has any questions. If not, that's fine. I have some questions myself. Great. You actually taught me something, Donick. I didn't know what FICO stood for. So now I know that it stands for Fair Isaac Corporation. And thank you for teaching me that.
Awesome.
So yeah, I wrote down some questions as you were speaking, but as you went through, I ticked some of them off because I did have a question about self-employment people, because I probably, like a lot of our viewers, are self-employed. So I need to have my business going for 2 years to show the bank or the lender that I'm successful, that I have sort of consistent income before I can get a mortgage.
Yeah, there are also some strategies in there, but that will be an expensive way of doing it. So there are lenders, there are other lenders that would be able to accept not 2 years of history, but there are a lot of consideration that need to be included. So it's if buying a house is really important for that person, there are ways to be able to do it. It's just going to be more costly.
Yeah, I noticed you had like 4 points that they look for. So credit score, income. So those things can be played around with a little bit. So if, say, a newcomer came and had a really big down payment, then they wouldn't necessarily be looking for work history and some of those other things. Is that correct?
Yeah, because of COVID, a lot of things had changed. Before, if you have like 35% in down payment, sometimes you don't need to have any work history. Now they would still want to look at a, a reasonable source of income for the continuous payment of it. But having a 35% down payment, for example, would have an impact in terms of you being able to get a mortgage.
Okay, great. So it's changed a bit. So I didn't know that it's changed because of coronavirus. That's good to know. Yeah, great. I also had another question about real estate investing. So is the process different if you're an investor, say buying a place to rent out or maybe to flip and then sell in the future? Or is it basically they're looking at the same things?
So there will be a difference in there. If you're going to occupy that property, it doesn't necessarily mean that it's your first home. As long as you're going to live in that property, you can put in 5%. But if you are going to pay, if you're going to have it rented out, you would need to pay at least 20% down payment.
Okay.
Yeah. The income that you would have from the rental property, the income from the rent itself, most lender would only consider 50% of that as an additional income. So not 100%. So even though you're going to receive income from it, right, it would still be just 50% to be added onto your income. But you would have the 100% liability for that new mortgage.
Okay, great. That's awesome. I had another question about trailer parks. So maybe some of the viewers don't really know what a trailer park is. So from your presentation, I think it's basically like a leasehold. So basically you don't own the land that the trailer is on. You basically rent the spot and you own the building. So you would get a mortgage only on the trailer, not on the land that it sits on.
Yes, and there are very few lenders out there that are extending mortgage on we call it mobile home or mini home. The park itself is a trailer park, but the term that will be commonly used will be mini home and mobile home. There are still lenders that extend mortgage on mobile homes, but not a lot. You could, if you would be able to buy a land and build a mini home in there, wherein that home could not be hauled away by a truck, right? It means that it has to be affixed on the land itself. There are still lenders that will be willing to extend mortgage on those.
Okay, great. Yeah, maybe they don't use trailer park anymore. That sort of has a negative meaning because of, you know, there's a TV show called Trailer Park Boys. I don't know if you've seen that, but if anybody's watching this, yeah, it's basically a bunch of guys and they drink a lot of beer and cause a lot of trouble. So trailer parks sort of have a bad reputation. So mobile home is a much nicer term for that.
Right.
Yeah. Great. We do have a couple comments, Donick. So Jalile says, thank you for the information. Thank you for watching, Jalile. If you have any questions, we still have a few minutes left for you to ask those. And Zara said, thank you, Ian and Donick, very informative session. So thank you very much for watching, Zara. Do you have any questions? We still have a few minutes left. Okay, I think basically you've covered most of my questions. Maybe I have one other question. You were talking about a seller's market. So as you probably know, if you've been watching the news, the prices of houses are climbing like crazy. And, you know, at the beginning of coronavirus, maybe they didn't know what would happen with house prices. Maybe they thought they would fall because of people losing their jobs, but they've seen a huge increase up over maybe 10 or 11% year over year. So what are you seeing in the Halifax area? Like, what's the average price, and is that going to keep going up in the future, do you think?
Yeah, so I'm pretty sure the realtor that you're going to have next week would also mention it. But the prices that we're going to have, especially during summertime, will be higher. We have historical prices for January and February. You could see that information from CREA, so Canadian Real Estate Association, the statistics that are available for Nova Scotia. And same thing with New Brunswick. I have some clients in New Brunswick too. Prices are increasing, considering that it's winter time. And based on the trend that we're seeing, the prices are going to go up. So a lot of people are finding ways to be able to acquire a house without really overpaying. So one story that I have is
Oh, Donick cut out. Can you hear me, Donick?
right. So
there we go.
one strategy there
Sorry, Donick,
is
can you hear me?
Yeah, I can hear you now.
Sorry, you cut out for a second. Do you mind just repeating the last 30 seconds of what you were saying? I think some of the viewers missed it.
Yeah, no worries, no worries. So based on the trends that are happening, the prices are still going to go up. And also the interest rates have been going up the past few weeks. Few weeks or a month ago, what we actually have a lender that offers 1.35 right now. Majority of our lenders are offering 1.89, and just a matter of few weeks, right? So it's important for us to know. And if you are ready to buy a house, make those plans now. If, for example, you're not in a hurry, for me as a real estate investor myself, we have 3 properties. If you're not in a hurry, buying during winter time will be ideal, because there are fewer people who want to move during winter, right? Because there's snow on the ground, right? It's too cold too, right? So if you're not in a hurry, buying during winter time will be ideal. Lesser competition, but there are still some sellers in there.
Great. Yeah, one more question about that, Donick. So what is driving these prices so high? So is it higher population, or is it people scared that they're going to miss out and rushing to buy now before the prices get higher and higher?
Yep. So that's a great question. So a lot of factors have an impact in there. One, a lot of people from other provinces are moving here. Say, for example, I have a lot of clients that are moving from Ontario because the prices in Ontario are increasing, and they see that, oh, I can work from home now. So they're moving to Nova Scotia, and our economy here in Nova Scotia is also booming, and also immigration in Atlantic province have been increasing with the AIPP, right? And now it's permanent, the Atlantic Immigration Program that brought in a lot of immigrants into Atlantic province. So law of supply and demand. There's huge demand. There's also few supply. Also, it also had an impact that the military, most of the time, people in the military would be stationed to different provinces, right? So there are going to be houses that are going to be for sale because they have to leave and move to a different province. That had been postponed. So again, the inventory that we have will be lower.
Okay, that was a great answer. Okay, we just have a few more questions. We have a few minutes left. Jalile has a question. So if you can share this session, please. She missed some parts. So this is a good announcement for everybody, but this session will be available online afterwards. So it will be on our YouTube channel. So you can just go to YouTube, search for Right Start Newcomer Services, find our channel. Please subscribe, please like the video, and all of our sessions will be available afterwards. So everybody can go at any time and check those out. Okay, thanks, Jalile. Next question, well, it's a statement. Thanks for the informative session. Thank you, Hannah, for watching. and we're really glad that you joined us tonight. Here's a question from Zara. Can you please tell us more about the RRSP loan?
Yep, great question. So RRSP loan, it means that you would borrow money from a financial institution or a bank. Say, for example, usually it's based on your net equity. If you have 20,000 in your savings account, right, you would a lender will lend you 20,000, and the condition is that you're going to put that 20,000 into your RRSP. By putting money in your RRSP, you would be able to receive a tax refund. Say, for example, your effective tax rate is 30%. Assuming you don't have any other liability on your tax impact on your tax side, so 20,000 times 30%, you could potentially receive a tax refund of 6,000. So that money, your net worth before was 20,000. You have a liability of 20,000, but you also have an asset in your RSP of 20,000. So that offsets itself. But then you have a tax refund of 6,000. Your net worth now becomes 26,000, and then that money that you have in your RRSP, you could use it as home buyer plan, as a down payment, and even a closing for your purchase of your property. You could borrow up to 35,000 in your RSP, assuming you have 35,000 in your RSP. That's both spouse can have 35,000. But if you only have 20,000 in that RSP, you can only borrow up to 20,000.
Right. That was a great answer. Yeah. So if you do have an RRSP, look into getting a loan to grow your RRSP, and then you can look into the home buyer plan that allows you to take money to from the RRSP to buy your. Is it your first home or? Yeah, I don't think you can do that multiple times. Yeah.
Yeah. So first home. It also could, even though, say for example, you could do it in the future too. Say for example, you bought a house 5 years ago, and then you sold that and you stayed in an apartment for 5 years, and now you want to buy a house. You could requalify for that home buyer plan. The cool thing is that you're able to use that money in your RSP without returning the tax refund.
Oh, nice. Yeah, great. Yeah, so it's a great way to save up for your retirement and also to build a house, or sorry, to buy a house. Great, Great question. Thank you, Zara. And one more question from Jalile. So for those who are buying a property for the first time, is the tax rate different from those who have bought a property several times? What's the percentage? So the tax rate, I guess, she might be talking about property tax or possibly, the land transfer tax, maybe.
Yeah, so we'll discuss those. Great question. So assuming we're talking about property tax usually depends on the local government, right? If there's a need for us to be able to generate more revenue for infrastructure in our community, they might increase the property tax on different areas. There are areas that would have a higher property tax. There are other areas that will be lower. And then in terms of the deed transfer tax, that also would vary. Most of the time in major areas in Halifax and in Dartmouth, it's going to be 1.5%, and that's the one that goes to the government. So that's being used for infrastructure. So definitely, if the community that you are in is booming and it's growing, and there are a lot of need for new development in there, say for example for Bedford area, we used to live there. We rented out our property. The property tax in West Bedford will be higher compared to other areas in HRM.
Oh, interesting. I didn't know that. Yeah, just to make sure everybody understands that land transfer tax is a one-time tax. So it's a 1.5% on the value of the property you're buying. It's not every year you have to pay 1.5% of the value. So
correct.
That would be considered a closing cost. So make sure you have that money saved up because there's more than just the down payment to consider when you're buying a house. Yeah, great question, Jalile. Okay, so I'm aware of the time. It is 7:15. I want to thank all of the viewers. So thank you very much for watching.
Thank you.
If you're watching later on YouTube, thank you very much as well. Don't forget to subscribe and like. And I also want to thank Donick for his time. So he gave us a lot of great information, and he also shared his info. So if you wanted to give him a call, I think he shared his email address as well. So do you want to just, I'll put your number up real quick, Donick. So what was your telephone number again?
So it's 902-292-1368.
68. Perfect. So I'm just going to show that here. Is that correct? 902-292-1368. So give Donick a call. He'd be happy to answer your questions. And if you're looking for a mortgage, he's a trustworthy guy. So
thank you.
Check him out for that. Okay. Thank you, everybody, for watching. Thank you again, Donick. Great job tonight. And see you next week to talk about buying a house. So we'll talk to 2 realtors next week who are very familiar with the local Halifax market, and we'll be able to get some great information there. Okay, thank you very much, everybody. Thank you, Donick.
Thanks, everyone. Thanks, Ian.
Yeah, you're welcome. Good night.
Good night.